Welcome to Corporate Finance. Welcome to session 9 of Introduction to Corporate Finance. And in this session, we're going to talk about several methods, 6 to be exact, methods of evaluating large capital investments, like if you're putting in a new plant or a new building. It might be a new chemical plant, a new filtration system or precipitation system, a new inventory management system. Some of these new properties have sales affiliated with them. Some don't. You put in an inventory management system, there's not going to be any sales affiliated with that. So we'll look at how to value these major capital investments. Method number 1, and the best method to use for these large capital investment projects is net present value. From this day forward, we're in search of positive NPV projects. Payback rule is the second method we'll use, and the CFO will ask you, after she gives you $50 million for your project, when are you going to pay me back? I need to know. It has to be within 3 years. She'll give you a payback period that you have to agree to. Then there's a newer method, method 3, called discounted payback, where I discount the future cash flows back to today and see when we pay her back. Next is average accounting return, average net income divided by average book value. So very simple income statement, balance sheet relationship, and we can look at, by dividing two numbers, the AAR return. Then there's the internal rate of return. Method number 5, very powerful method of looking at the return on an investment, it's the rate at which my discounted cash inflows equals my cash outflow today. So IRR, very powerful, very important that you learn how to do it and use just about universally these days. And then finally, what are some tenets of capital budgeting? Which methods are most popular out there when you get out into the real world? And which ones of those 6 methods should I know by heart and very quickly? All of these will be discussed in session number 9 on NPV and other investment criteria. So we'll go over some key formulas to know, and we'll look at, like I said, 6 different methods on our roadmap of learning objectives. First one is NPV. NPV is the best method for evaluating large capital investment projects. It has the fewest drawbacks. It's very simple. An investment is worth undertaking if it creates value. Here's an example of we buy some land for $125,000, put some labor and materials into it. We eventually sell that house for $300,000. So the question is, do we have a positive NPV project? From now on, from this day forward, we're going looking for positive NPV projects. The NPV in this case is the market value, or $300,000 minus the cost of the investment, or $250,000. So we have a positive NPV of $50,000, and that tells us to accept this project. Good investment. NPV rule is very simple. Positive NPV, accept. Negative NPV, reject. Again, we're going looking for positive NPV projects. We're going to use discounted cash flow analysis that we developed in Chapter 6. We evaluate an investment by discounting its future cash flows. We estimate the initial cash outflow, which we know today, and then we have to estimate future cash inflows, which is a little bit more difficult to figure out. And then we calculate the net present value of those cash inflows. Let's go into the fertilizer business. Cash revenues of $20,000 per year, cash cost of $14,000 per year, 8-year project. We can salvage the equipment at the end of the project for $2,000. And the project cost us $30,000 today, so we should develop a timeline. Our discount rate at our company, our weighted average cost of capital, our hurdle rate is 15%. So we're going to use that rate to discount the cash flows. Again, we set up timeline like I recommended back in Chapter 6. For Chapters 6 through 11, create yourself a timeline. It's easier to see these problems. Initial cost is $30,000. For that, we're going to get a cash revenue inflow of $20,000, cash cost outflow of $14,000 each and every year for 8 years, giving us a net inflow of $6,000. So it looks like an annuity to me. Salvage value at the end of the project is $2,000. And there are our total cash flows that we're going to discount back to today to see if this is a worthwhile project. So since we do have an annuity, C times 1 minus 1 over 1 plus R to the T, all of that over R. plus the future value of that $2,000 salvage value brought back to today. Divide that by 1.15 to the eighth, and we get a minus 2,422 NPV, which makes it a bad investment. Okay, bad investment, negative NPV, reject.